that many balance sheets are carrying. Samiran Chakraborty, Managing Director and Head of South Asia Macro Research at Standard Chartered Bank, is joining us now with the details of his latest report, where he argues that one of the big headwinds for the growth story, for the India story, is the very high corporate debt. Samiran, in your own words, tell us the summary of this. Give us the details of the extent of debt. Is it as bad or worse than it was in the 2000-2003 upturn that the economy saw? And therefore, is that proving to be one of the big stumbling blocks for growth?
In fact, we start with saying that there are three cyclical headwinds which probably we underestimated. One is corporate leverage, the second is low levels of capacity utilization, and the third is high level of banking system NPAs. In this report, we particularly look at the corporate leverage part of it, and probably we'll get time to do the next two in some other reports. Now, if I just look into the corporate leverage part of it, we have broken this up into two periods. One is the pre-global financial crisis period, the other is the post-global financial crisis period. And it's interesting that in the pre-global financial crisis period, while debt went up very strongly, it was also backed by a significant amount of equity raising. So the overall financials were not so stressed. Whereas in the post-financial crisis period, we have not only seen less amount of equity raising, but also profitability declining very sharply. So we see a PAT growth of only 9% against a debt growth of almost 20%. So that's putting much more stress on the financial statements of the corporates. And the way out from here to our mind is simply that either we will have to deleverage, or the growth expectations will have to pick up, or there should be significant amount of public investments. We do not think that rate cuts are necessarily a big solution to this problem, because we find that between the first phase, pre-global financial crisis, and post-global financial crisis, real interest rates have declined almost 600-650 basis points, but still overall investment has not picked up in the second phase because growth expectations have been much more moderate.
Okay, that's quite a grim situation that you've laid out. Samiran, hi, morning. Since you've done a lot of work on this corporate debt situation, can you give us some numbers? What was the gross debt of the BSE 500 companies by the end of FY15, and how much do you expect it to rise to, say, by the end of FY16?
So, just to give you some perspective here, in 2003, the gross corporate debt was about 2.3 trillion rupees. This has gone up almost 10 times to now about 24.3 trillion rupees by the FY15 end. So it's almost a tenfold increase that we are seeing. And the growth rate in the second phase, the post-global financial crisis phase, has been about 18% in corporate debt. Whereas in the first phase, pre-global financial crisis, the growth rate was more than 40%. So the growth rates have come down. If you extrapolate that for the next year also, you would probably get a number of about 26 trillion for the overall 26-27 trillion for the overall debt. But the good news is that between FY14 and FY15, we see that the debt ratios are improving marginally. We are not yet saying that this is good enough, but that the kind of trend that we want to see has started happening in the last 1 year or so.
Okay, can you extrapolate more on that? In fact, that's what I was coming to. Are you seeing, at least at the edges, some improvement? How much has debt fallen and how much has equity been raised?
Well, Lata, debt has not fallen. It's just that the debt-equity ratio is improving marginally from about 1.39 to about 1.34 in 1 year, which is a marginal improvement. Also, what we are seeing is that, and this is one of the problems that we find, is if you compare the equity raising in FY15 vis-a-vis the market valuations, then we find that that has been very poor compared to the historical records that we have. So probably companies did not utilize the opportunity enough last year of raising capital and thereby reducing the leverage.
Okay. Can you throw some more color, Samiran, on sectorally what is happening? I mean, which are the sectors which continue to have high debt? And are there any vulnerable sectors where the debt-equity ratio has improved, say, in the last 4 to 6 months?
Well, we honestly don't have the sectoral breakup so much for the more recent period, because we have to work with kind of standalone entity results for the near-term quarters, whereas for the earlier years we have the consolidated numbers. So that problem still remains. But having said that, sectorally, if you see, the interesting findings for us has been that out of the 80-odd infrastructure companies that we track, about 1/4 of them have interest coverage ratio less than 1. We find that for the power sector, the debt equity ratio is more than 5.5, which is the highest for any of the sectors. We find that in real estate also there is pressure, but probably not so much. In fact, the debt equity ratios are more manageable there. But other than these kind of usual suspects, we don't see the problem spreading to other sectors, which should be taken as a positive.
All right, Samiran, that's an exhaustive analysis, and it's an interesting report. Just your view. I mean, public investment has been stepped up in the latest budget in both roads and railways. Is that good enough? Is that a glimmer of hope that public investment is catching up? For you, that is the panacea, isn't it?
Yes, that's definitely one of the most important things, and yes, the central budget has given a little bit of a push to this, but the state budgets will also have to push the capital investment part of it, and both things combined will probably this year see close to ₹1 trillion of additional spend on the capex side, but the problem is that if it is very back-ended, then probably we will see through this stress going for the next few months. And the capital raising requirement for the companies is a humongous $80 to $90 billion over the next 3 years if they have to come back to the debt equity ratios of pre-global financial crisis. So you need a lot of support from the profitability side to get the debt equity ratios down, and for that profitability to improve, you need a large amount of public sector investment to come in.
All right, we'll leave it at that and continue the conversation after the result season, when you will have a better handle, I suppose, Samiran. Thank you very much for joining us and putting those numbers into perspective. The problem, I guess, was always known.